You've probably seen the headlines by now. India is quietly exiting U.S. Treasuries. 50? No press conference, no emergency meeting, just a slow fade into the background. Some channels are already calling this the beginning of the end for the dollar, the bond market, or the global financial system as we know it. Today, I want to slow this down, strip out the emotion, look at the actual data, and figure out what, if anything, really changed. This is Financial Briefing, and my goal here is clarity, not clicks. By the end of this video, you'll know what the numbers actually say, what they don't say, and how I'm positioning around it, calmly, deliberately, and without assuming a financial apocalypse. Before we get into the data, I want to do something this channel does consistently, keep a scorecard. 3 months ago, we said that Treasury yields would remain elevated into year-end rather than collapsing on recession fears. The 10-year was around 4.2% at the time. It spent most of the last quarter between 4.3 and 4.6. That call held. Back in late spring, we also said gold breaking above $2,300 wouldn't automatically mean a straight line move to 3,000. Instead, we expected consolidation. Gold topped near 2,450, pulled back, and turned sideways for weeks. That also played out. And finally, we were cautious on silver in the low 20s last year, saying the upside would come later and be volatile. Silver is now trading in the low to mid 30s, but with exactly the kind of violent swings we warned about. Some calls work, some don't, but the framework matters more than being perfectly right. Now let OS talk about the claim itself, that India unwound roughly $50 billion in U.S. Treasuries. The first data point is the actual holdings. According to U.S. Treasury International Capital data, India's Treasury holdings peaked near $240 billion in 2021. Billion dollars. As of the most recent reporting, they're closer to $190 billion. That's a reduction of about $50 billion over roughly 3 years. In context, that's about a 20% decline. Historically, India's holdings have fluctuated significantly. In 2013, they were under $60 billion. By 2018, they were above $160 billion. So what does this mean? It means India has been gradually adjusting its reserve composition over multiple years, not executing a sudden exit. What it doesn't mean is that India woke up one morning and decided the U.S. Treasury market was unsafe. The second data point is the pace of change. The reduction didn't happen in one quarter. It wasn't even concentrated in a single year. Most of the decline occurred between late 2021 and mid-2024, during a period when U.S. yields were rising sharply and the Federal Reserve was tightening aggressively. In that environment, many reserve managers shortened duration, reduced exposure, or rebalanced toward domestic needs. What this means is that selling treasuries during a rate shock is often about risk management, not ideology. What it doesn't mean is a coordinated geopolitical signal or a sudden loss of confidence in U.S. creditworthiness. The third data point is where the money likely went. India's total foreign exchange reserves have remained relatively stable, hovering around $600 billion. That tells us something important. This wasn't a liquidation to fund a crisis, it was a reallocation. Some of that likely went into domestic liquidity support, some into shorter duration dollar assets, and some into gold. India's official gold reserves have increased steadily over the same period, rising from roughly 700 tons a decade ago to over 800 tons today. What this means is diversification, not abandonment. What it doesn't mean is that treasuries are being replaced one for one by gold in a dramatic vote of no confidence. Now let's look at the bullish interpretation, the scenario where this really matters. First, if India is ahead of a broader trend among emerging market central banks, this could signal sustained marginal selling pressure on treasuries over time. Not a crash, but a steady erosion of foreign demand. Second, if reserve managers increasingly favor gold over sovereign debt, that structurally supports higher gold prices, especially in a world of persistent fiscal deficits. Third, this kind of quiet rebalancing fits a broader theme of de-dollarization at the margins. Less about headlines, more about slow shifts in behavior. And fourth, if treasury supply continues to rise while foreign demand plateaus, yields may need to stay higher for longer to clear the market. Put together, I'd assign about a 25% probability to this developing into a meaningful bullish tailwind for precious metals and a headwind for long-duration bonds. But there's also a bear case, and it deserves just as much attention. First, $50 billion spread over several years is small relative to a $26 trillion treasury market. It's a rounding error in terms of daily liquidity. Second, India is not unique. Many countries adjusted reserves during the same period due to rate volatility, currency management, and domestic priorities. Third, U.S. Treasuries remain the deepest, most liquid, risk-free asset in the world. There is no true replacement at scale. And fourth, if yields stabilize or fall, reserve managers could just as easily re-enter at higher yields. In this framing, the story is being retrofitted after the fact. I'd give this overblown interpretation about a 35% probability. That brings us to the middle case, which is where I land. The most likely scenario is that this was a gradual, pragmatic reserve adjustment during an extraordinary tightening cycle. No panic, no statement, no secret exit. Just portfolio management. In this case, treasuries remain central to global reserves, but the marginal bid from foreign central banks is weaker than it was a decade ago. That's supportive for gold at the margin, neutral to slightly bearish for long bonds, and largely irrelevant for day-to-day market moves. I'd put this middle path at about a 40% probability. It helps to zoom out historically. In the early 2000s, several Asian economies accumulated treasuries aggressively to manage exchange rates and build war chests after the Asian financial crisis. That was a period of rising foreign ownership. After 2014, we saw a plateau, then a slow decline. The similarity today is that reserve policy is again driven by domestic stability and risk management. The difference is the starting point. Back then, yields were falling and debt levels were lower. Today, yields are higher, debt is much larger, and the US is issuing far more supply. So while the behavior rhymes, the macro backdrop is very different. Cross-market signals matter here. Gold is trading around 2,350 to 2,400, well off its highs but still elevated. That suggests ongoing institutional interest but not panic buying. The dollar index has been range-bound, not collapsing, which tells us there's no rush to exit the dollar, and the 10-year yield remains above 4%, signaling that the bond market is more concerned with inflation and supply than foreign selling. Taken together, these markets are saying adjustment, not crisis. Positioning data supports that view. Commitment of traders reports show large speculators already long gold, but not at extreme levels. Commercial hedgers are active, but not aggressively leaning against the move. Banks are positioning for volatility, not collapse. Institutional flows into gold ETFs have been uneven, not one-directional. This doesn't look like a market bracing for a seismic shift in reserve policy. So what am I doing with this? Here's my framework. If we see confirmed accelerated selling of treasuries by multiple major reserve holders within a short window, then I increase my gold allocation modestly, focusing on pullbacks, not breakouts. If yields spike above 5% without a corresponding rise in inflation expectations, I reduce duration exposure further. Currently, my allocation is roughly 15% precious metals, split 10% gold and 5% silver, 55% diversified equities, 20% short duration bonds and cash, and 10% alternatives. My stop loss on silver is a weekly close below 28. My take profit zone is staggered between 36 and 40. This is not advice. It's just my framework. What I'm not doing is panic buying gold because of a headline. I'm not doom scrolling channels predicting imminent dollar collapse. And I'm not assuming that every reserve adjustment is a political statement. Markets are complex, motives are mixed, and patience matters. Here's what I'm watching this week. First, upcoming treasury auctions. Strong demand would undermine the exit narrative. Second, gold's behavior on down days and yields. If gold holds firm even as yields dip, that's constructive. Third, any official commentary from reserve managers, not rumors but statements. Bullish triggers would be weak auction demand, resilient gold, and rising central bank purchases. Bearish triggers would be strong auctions, a stronger dollar, and fading gold momentum. So let's wrap this up. 1. India's treasury reduction was real but gradual. 2. It reflects diversification, not abandonment. 3. The market response has been measured, not alarmed. And 4. The opportunity here is in disciplined positioning, not emotional reaction. If this kind of analysis helps you cut through the noise, consider subscribing. This is Financial Briefing. Thanks for listening, and as always, stay sharp.